Personal Finance PowerPoint Presentation. Index Funds. Prepare to get financially fit by practicing personal finance. Support accounting instruction by clicking the link below, giving you a free month membership to all of the content on our website, broken out by category, further broken out by course. Each course then organized in a logical, reasonable fashion, making it much more easy to find what you need than can be done on a YouTube page. We also include added resources such as Excel practice problems, PDF files, and more, like QuickBooks backup files when applicable. So once again, click the link below for a free month membership to our website and all the content on it. Most of this information comes from Investopedia. What are index funds, which you can find online? Take a look at the references, resources, continue your research from there. This by Jason Fernando, updated July 7th, 2022. In prior presentations, we've been taking a look at investment goals, strategies, tools, keeping in mind the two major categories of investments, that being the fixed income, typically the bonds, the equities, typically the common stock. Also thinking about tools we might be using, such as mutual funds, ETFs, possibly helping us to diversify with a less of an initial investment than if we invested in individual stocks and individual bonds. Keeping that in mind, we're now asking, what are index funds? An index fund is a type of mutual fund or exchange traded fund, an ETF, with a portfolio constructed to match or track the components of a financial market index, such as the Standard & Poor's 500 index, the S&P 500. So when we're thinking about investing as individual investors, we could invest in individual stocks, individual bonds, but that's often costly and difficult to be able to diversify with, diversification being one of our major goals. Therefore, we often use something such as the mutual funds or the ETFs, which are going to help us to pool investments together with other investors, having a fund manager then allocate those funds in accordance with whatever the rules are of the fund. Now, when we then have those funds, we could use an actively managed fund manager, giving the ability to the fund manager to be able to have more control over where they're going to put the money in an attempt to beat the market, get better returns than the market. But remember that then, of course, you're paying a highly educated, generally highly paid fund manager to be making those kinds of decisions. And some would argue that if you think the market is efficient, that maybe you would be better off just betting on the market in general overall, as opposed to a fund manager trying to beat the market. Now, what do we mean by a fund manager beating the market? That means they're going to get a better return than on average the market in general. Therefore, we got to compare it to what the market does. How do we know how well the market is doing? They've made up kind of tools for us to kind of measure how well the market is doing. There's similar tools to taking like a poll. You can think about taking a poll of a bunch of people to determine, say, what the average height of an American is or something like that. They're not going to try to take the height of every person in order to make that comparison. They're going to take a sample, and hopefully the sample is large enough to extrapolate to the entire population, and that's what they're going to be using. So similar kind of process with different areas of the stock market. We can try to take an average of companies that we think are representative of the entire stock market to get a feel of how the stock market is doing as a whole, or a particular segment in the market. And therefore, those are kind of our averaging techniques. So if we're going to set up a mutual fund, we're going to say, hey, maybe if I want to bet on the index, the average of the Standard & Poor's 500, S&P 500, I could set one up to just tie it to the S&P 500, tie it to the index itself, tying the hands of the fund manager, making it cheaper for them to manage the fund, or I can let them invest in whatever they want, and the objective would be, if it's something comparable to the S&P 500, would be for them to beat the returns of the S&P 500 in order to justify their salary, in essence, as the fund manager. So an index mutual fund is said to provide broad market exposure, low operating expenses, and low portfolio turnover. These funds follow their benchmark index regardless of the state of the markets. So the benchmark index would be the index under which, so if it was tied to the S&P 500, Standard & Poor's 500, and if it was actively managed, we might still kind of tie the manager's hands to be investing in an area that's covered by the Standard & Poor's 500, but the full population, as opposed to just tying it to the index, the ones that have been chosen to give the average kind of return. Or we can tie it to the index so we don't have as much leeway for the manager, which should be cheaper to do. So index funds are generally considered ideal core portfolio holdings for retirement accounts, such as individual retirement accounts, IRAs, and 401k accounts. So if you're investing in an IRA or 401k, remember those things are not different than basically mutual funds. They're just an added kind of level or umbrella over the investment. So many people think that those things are like a whole different animal, but they're not really, because you're still investing usually in some kind of mutual fund, often in, say, index funds, for example, that might cover a broad swath of different stocks. So that means you can have tax implications under a 401k or an IRA, but you're still invested in some kind of mutual fund, generally, oftentimes, most of the time. So legendary investor Warren Buffett has recommended index funds as a haven for saving for the later years of life. So rather than picking out individual stocks for investment, he has said it makes more sense for the average investor to buy all of the S&P companies at the low cost that an index fund offers. So basically the idea would be, you're going to be paying a cheaper amount for the index funds unless you're going to do a whole lot of research in order to beat the market. Then that might be a good strategy to use. How an index fund works. So note that for a lot of people, that would be like the baseline strategy, right? You're going to say, as an individual investor, you might want to have some diversified strategy over index funds, betting on the market as an average, as a whole, having a broad-based index fund, possibly one index fund, or you can try to have multiple funds that are going to cover different segments of the market, allowing you more control over the percentages of your allocation than simply, say, one fund, for example. But the general idea would be the index funds would be an individual investor's kind of baseline type of investment. And then if you wanted to then pick other things such as actively managed funds, you might want to be quite critical in terms of why you're picking an actively managed fund, where that actively managed fund will be, so that maybe you can track the performance of an active manager, see if they're actually beating the index for whatever reason. So we got the indexing is a form of passive fund management. So if you hear the term passive fund management, it's a similar thing, because when you have an active manager, that means you've untied the manager's hands. You've got the manager trying to beat the index, trying to do what they can do. And if you have a passive manager, they're really just kind of managing the allocation of the portfolio to the index. They're not investing whatever they want. So instead of a fund portfolio manager actively stock picking and market timing, that is choosing securities to invest in and strategizing when to buy and sell them, the fund manager builds a portfolio whose holdings mirror the securities of a particular index. So the idea is that by mimicking the profile of the index, the stock market as a whole, or a broad segment of it, the fund will match its performance as well. So there is an index and an index fund for nearly every financial market in existence. So this was a huge concept when mutual funds came about, huge concept, and then index funds came about, and it was huge, and it's a huge thing. And now we've got a wide variety to be able to choose from, which is very nice. So in the United States, the most popular index funds track the S&P 500, but several other indexes are widely used as well, including you got the Wilshire 5000 Total Market Index, the largest U.S. equity index. We got the MSCI EAFE index, consisting of foreign stocks from Europe, Australia, and Far East. So now we've even got these capacities to use mutual funds and index funds outside of U.S. markets. Bloomberg U.S. Aggregate Bond Index, which follows the total bond market, so we can use index funds for bond investment to diversify our portfolios. NASDAQ Composite Index, made up of 3,000 stocks listed on the NASDAQ exchange. You got the Dow Jones Industrial Average, consisting of 30 large cap companies. So a bunch of options on the indexes. It's great. So if you're looking on your investment. In looking at your investments, you might be looking at like a Vanguard or something like that, has a whole lot of different kind of investments, and you might try to search by index funds if you choose to, or you might search and compare index funds to their related actively managed funds and see the performance of them. So an index fund tracking the DJIA, for example, would invest in the same 30 large and publicly owned companies that comprise that index. Portfolios of index funds only change substantially when their benchmark index change. So if the fund is following a weighted index, its managers may periodically rebalance the percentage of different securities to reflect the weight of their presence in the benchmark. So as time changes, you're going to try to weight it to the index, and then things are going to change as time passes with the earnings of the index, and they might have to re-weight it periodically to put the weights, the percentages in alignment with the index that they are benchmarking to. So weighting is a method that balances out the influence of any single holding in an index or a portfolio. Index fund versus actively managed funds. Investing in an index fund is a form of passive investing. So meaning we're trying to invest in the market as a whole in a more passive way, as opposed to individual stock picking, where we're trying to, in essence, beat the market, beat the indexes, beat the averages. So the opposite strategy is active investing, as realized in actively managed mutual funds, the ones with the securities picking market timing portfolio that managers describe above. So lower costs. One primary advantage that index funds have over actively managed counterparts is the lower management expense ratios. So you can compare the expense ratios on the index funds to the actively managed funds. Note that the active managers, they would have to be quite knowledgeable if they're going to beat the market, right? So they're going to be fairly highly paid, and therefore the expense ratios are going to be quite higher. Therefore, they have to beat the market by a fairly significant amount in order to justify the higher expense ratio, as opposed to just tying the investment, say, to the index, betting on the market as an average or as a whole. So a fund's expense ratio, also known as the management expense ratio, includes all of the operating expenses, such as the payment to advisors and managers, transaction fees, taxes, and accounting fees. Because the index fund managers are simply replicating the performance of a benchmark index, they do not need to services of research analysts and others to assist in the stock selection process. So it's going to be a whole lot cheaper if you're not trying to pick and choose stocks and have all this pressure to beat the market, if you're just tying the thing to the index, although you're still going to have some expenses in order to manage the portfolio to do so. So index fund managers trade holdings less often, incur fewer transaction fees and commissions. In contrast, actively managed funds have larger staffs and conduct more transactions, driving up the cost of doing business. The extra costs to fund management are reflected in the fund's expense ratio and get passed on to investors. As a result, cheap index funds often cost less than 1%, 0.2% to 0.5% is typical, with some firms offering even lower expense ratios of 0.05% or less. That's what I want to see, compared to the much higher fees that active managed funds command, typically 1% to 2.5%. Expense ratios directly impact the overall performance of a fund. Actively managed funds, with their often higher expense ratios, are automatically at a disadvantage to index funds and struggle to keep up with their benchmark in terms of overall return. So when you're talking, like when you watch a Bloomberg or some kind of stock market, you're usually looking at the active managers who are trying to justify, their active management strategies, and the way to justify that is, of course, to be beating the related index that they are compared to. And when they do, you're going to hear about it, right? Because they're going to try to tell you why they're doing good, and when they don't, then they're probably not going to go on the TV show at that point. So you might have some biased opinions sometimes. So keep that in consideration. So if you have an online brokerage account, check its mutual fund or ETF screener to see which index funds are available to you. Pros of the index: lower risk through diversification. So we can have these broad index funds giving us diversification, which is great. Low expense ratios because we're not paying the fund manager, they're just tying them to the index, which is great. Strong long-term returns. So hopefully the exposure in a broad return will give us long-term returns, which are great for retirement plans. Ideal for passive buy and hold investing. So it's less stressful. We're just going to be investing as a whole in the market as a whole and passively investing and hopefully doing better even than maybe the active investors. And we're not looking at it all the time and stressing ourselves out because we have our strategy in place and hopefully it's a good one and we could stick to it. So lower taxes for investors, which is nice as well. On the con side, vulnerable to market swings and crashes, lack of flexibility, because of course you're tied into an index with a mutual fund. So if there are swings, like if you were able to say, hey, look, there's a recession coming or something like that, and you want to shift things around, it's a little bit more difficult because of course you're tied to an index. You don't have an active manager that's doing that. But then again, the question is, can the active manager actively and correctly do that over the long run? That's questionable. Lack of flexibility because of course you're tied to the benchmark. And no human element involved because once again you're kind of tied to the indexes, which are picked by humans ultimately, but they're averages that are tied to the indexes that we are then tying to. Limited gains as opposed to active managers that would be limited gains. So better returns. Advocates argue that passive funds have been successful in outperforming most actively managed mutual funds. So again, if you're talking about a comparison between an active manager and a passive fund, the active manager would have to say that they're outperforming. Now, there could be some active managers that are outperforming, but if you look at all of the active managed funds, then it's not so clear as to whether they're outperforming as a whole. It's also confusing to look at one actively managed fund or one particular person that we think is some kind of guru or genius, because again, they could be good for some short period of time. They might have just gotten lucky for some short period of time and now they're boasting their track record, or they might just have a good strategy, but they happen to be more aggressive or less aggressive or whatever, which happen to match the current environment at this point in time. And if that environment changed and it would be more advantageous at that point to be less aggressive or something like that, then they might not be able to adjust. They might just happen to match at the current point in time. So you really have to look at someone's whole investment life to determine whether they're actually a guru and can follow the ups and downs of the market and be able to change their investment strategy, or if they just kind of lined up, got lucky or whatever with the current place. So you want to be picky with your investment, your actively invested funds, I would think. So indeed, a majority of mutual funds fail to beat their benchmark or broad market indexes. For instance, during the 5-year period ending December 31st, 2020, approximately 75% of large cap US funds generated a return that was less than that of the S&P 500, according to SPIVA scorecard data from S&P Dow Jones Indices. On the other hand, passively managed funds do not attempt to beat the market. Their strategy instead seeks to match the overall risk and return of the market on the theory that the market always wins. Passive management leading to positive performance tends to be true over the long term. With shorter time spans, active mutual funds do better. So notice that if you're looking under a shorter time horizon, then you might have different strategies that are going to be taken into consideration. It's a little bit harder to see how well people are performing if you lower kind of the time horizon. If you're in a long time horizon, you might want to bet on the market as a whole. The SPIVA scorecard indicates that in a span of 1 year, only about 60% of large cap mutual funds underperform the S&P 500. In other words, approximately 2/5 of them beat it in the short term. Also, in other categories, actively managed money rules. So as an example, more than 86% of mid-cap mutual funds beat their S&P Mid-Cap 400 Growth Index benchmark in the course of a year. So that's an interesting. So for example of an index fund. So index funds have been around since the 1970s. So huge huge innovation, index funds, mutual funds in general, allowing capital to be allocated from individuals, allowing individuals to have more investment capacity. So the popularity of passive investing, the appeal of low fees, and the long-running bull market have combined to send them soaring in the 2010s. For 2021, according to Morningstar Research, investors poured more than $400 billion into index funds across all asset classes. For the same period, actively managed funds experienced a $188 billion in outflow. So the one fund that started it all, founded by Vanguard chair John Bogle, I probably didn't say that right, in 1976, remains one of the best for its overall long-term performance and low cost. That's the Vanguard 500 index, has tracked the S&P 500 faithfully in composition and performance. So Vanguard's still a pretty nice place to go, has a wide variety of funds. So that's one comparable place you can kind of check out to think about where your investments are setting up investments. As of Q2, quarter two, 2022, Vanguard's Admiral shares, that's the VFIAX, posted an average 10-year cumulative return of 237% versus the S&P's 238.1%, exhibiting a very small tracking error. The expense ratio is 0.04%, which is pretty low, and its minimum investment is $3,000 to get started on that one. So you got to put the minimum investment down to start rolling, and then I think you could put in lower amounts after that point. So how do index exchange traded funds, index ETFs, work? Index funds may be structured as exchange traded funds, index ETFs. These products are essentially portfolios of stocks that are managed by a portfolio financial firm, in which each share represents a small ownership stake in the entire portfolio. So for index funds, the goal of the financial firm is not to outperform the underlying index, but simply to match its performance. If, for example, a particular stock makes up 1% of the index, then the firm managing the index fund will seek to mimic that same composition by making 1% of its portfolio consist of that stock. So we have a similar kind of situation, of course, with the ETFs. I won't get into a lot of differences with the ETFs and the mutual funds. We've talked about that in the past. But do index funds have fees? Yes, index funds have fees, but they are generally much lower than those of competing products. Many index funds offer fees of less than 0.2%, whereas active managed often charge fees of more than 1%. So the fees are going to be a lot less for the index fund than the active managed, which is one of the big benefits. The difference in fees can have a large effect on investors' returns when compounded over longer time frames. This is one of the main reasons why index funds have become such a popular investment option in recent years. Are index funds better than stocks? Index funds track portfolios composed of many stocks. As a result, investors benefit from the positive effects of diversification, such as increasing the expected return of the portfolio while minimizing the overall risk. So clearly, index funds have a benefit in that they allow you to invest more with less upfront, therefore allowing you to further diversify than buying the individual stocks. An individual stock could do quite well possibly, but you would think it would come up with a lot more risk as well because you're much less diversified. So while any individual stock may see its price drop steeply, if it is just a relatively small component of a larger index, it would not be as damaging.